I'm going to have you introduce yourself, but just want to say how excited I am to have you here. I've been a fan for a long time, then became a friend, and just delighted that you made the time to be here. So huge thank you from me.
My pleasure. Good to see you, albeit virtually.
I'll take what I can get. Why don't you go ahead and just give a brief introduction of yourself? There's a lot to share, but maybe give a brief, and if you miss any key highlights, I'll chime in myself.
Okay, sure. So my story is really software engineer turned entrepreneur, now turned investor. Not that unusual in Silicon Valley. I've never been a Hollywood actor like some people on this Zoom. So originally from Canada, telecom engineer, and then moved to Silicon Valley to work at Netscape, which some people on this call are probably too young to remember what Netscape was, and founded a bunch of companies, and then more recently co-founded 8-Bit Capital. So very recently a full-time investor.
Awesome. I love, I just have to say that your level of just humor and sarcasm is one of my favorite things about you. So I'll throw that into your introduction as well.
I don't know what you're talking about.
Exactly. Let's start with your angel investing journey. I know we're here to talk about sort of Signal, et cetera, but how did you get started? Just take us back to the early days.
Of angel investing?
Yeah.
When I was at Friendster, I think I was pretty concerned about potential conflicts of interest, as there were so many sort of Web 2.0 and social companies that were started by Friendster. After leaving Friendster, that's when I started doing angel investing. And I don't really remember how it got started, to be honest. In Silicon Valley, sort of everybody angel invests, right? But one of the earliest ones I did was SlideShare. And I remember I was just at an event like this, but in person, speaking. And afterwards, one of the co-founders of SlideShare came up to me and said, "Hey, I liked your talk. And I'm one of the co-founders of SlideShare." And I had already used their product. And I don't think they'd raised money, but they already had a product and I had used it. And I was like, "Oh, cool, I'll invest in your company." And that was one of my first angel investments. And eventually LinkedIn bought their company, and I did pretty well on that. So that was a pretty lucky, in terms of the outcome for one of the first investments.
Sure. Would you say then, as we talk about pattern recognition and sort of signals, I mean, being able to use a company's product sounds like, at least for you, is an important signal?
Well, it's definitely not the only one, because there's plenty of companies I've invested in where I didn't use the product or couldn't, or wasn't really applicable. But I do actually think that investing in products you like is generally a good idea, and I do like that. That was also the case for HelloSign. I was a big fan of the product. I still use the product, even though they've now been acquired by Dropbox. But yeah, I mean, if there's a product, I mean, it's so great if the company is raising their first round of funding and they've already built a product and you've used it and you like it. I mean, that's huge. So yeah, if there's a product that I'm able to use and I like, that certainly influences me towards investing. Of course, that's not applicable for everything, because sometimes it might be a really nerdy cloud computing product or a business product that really is only applicable at larger companies and doesn't really have sort of single person or VC firm use cases. So it doesn't always apply. In general, I would say that I'm actually not a fan of the term pattern recognition. And my opinion is that pattern recognition is a bug, not a feature. And I could give you a couple examples of that if you wanted.
Yeah, let's do it.
Well, so one example, I think somebody on this Zoom earlier mentioned married couples as founders. And I mentioned that one of my first angel investments was SlideShare. The founders of SlideShare were a married couple. And I remember that there were investors who turned them down for that reason. And they missed out a very good investment, because we made a lot of money on that company when LinkedIn bought them. And there are other examples of successful husband and wife co-founders that have done well: Eventbrite, Bebo, several others.
Totally agree. Actually, a flag went off in me as well, because I have friends and I've invested in amazing companies that are husband-wife couples. I think, to your point, yeah, pattern recognition, because it's a bug, not a feature, and it has been buggy. Why do people still talk about it? Why is it still deployed? Is there a way to use it in a way that it is, pattern recognition with exceptions, right? Like, thoughts on all that?
Well, I mean, I think it's the nature of the venture capital industry. The venture capital industry is very homogenous. It's a lot of white men from Stanford and Harvard business schools. I mean, it's not a diverse industry. And
is that still the case? I mean, obviously, 10 years ago, I think that was more the case. But do you think today that's still? I know there's a lot to be done around diversity, but those schools specifically, for example, or MBAs specifically, I feel like there's so many more operators that have turned investors that never went to even college.
It's changing because there's a lot of emerging managers that are more diverse. But in general, the industry is pretty homogenous. And even though it's maybe improved a little bit, it's still pretty poor. And, I mean, even taking race aside, the gender ratio in venture on Sand Hill Road is very poor, even though tons of women attend Stanford Business School. So, I mean, these are notorious problems, and they've improved a teeny bit, but not nearly enough. But I think, so the industry is an homogenous industry. There's a lot of groupthink, a lot of lemmings behavior. It's sort of an old boys network. So that's part of it. Yeah. And then there's a lot of credentialism. People like to invest in not only the person who looks like Mark Zuckerberg, but the person who went to Stanford, who worked at Google. So, there is that kind of thing. And obviously there's not everybody like that. So notoriously, for example, Dan Scheinman, he's been in the press as one of the few people who was comfortable investing in founders that were older, as in like maybe in their 40s, and he's done incredibly well. Felicis has invested in tons of international founders extremely successfully. So there's a lot of people who've had more diverse focuses and have generally done well. But I think that pattern recognition is one of those things that I actually think is not a good idea, but that 90% of the time you hear it and people say it as a good thing. They're like, oh yeah, you get a lot of experience as a venture capitalist and you have a lot of pattern recognition, and that's part of your advantage. So it's one of those things where I think it's a problem, but most people think it's actually a good thing.
One more thing before we move on, just out of curiosity, we've talked about pattern recognition, and the things we've used so far are race, marital status, age, which are all, they have nothing to do with tenacity, grit, etc. How do you feel about pattern recognition as it applies to personality, taking away sort of other things?
Well, I think those things are a lot more subjective. And I think ironically, founders who come from more diverse backgrounds sometimes are the ones who might have more grit and tenacity because they faced adversity. So the white male who went to Stanford or Harvard may be less likely to have the tenacity of the immigrant founder or the more diverse founder. But I do think we get caught up a lot of the superficial things, whether it's where you went to school or what you look like. One other example I'll give, one of my favorite angel investments is a company I invested in called Front that now is backed by Sequoia and doing extremely well. And I was an angel investor long before Sequoia invested. The founder is a woman from France. And because that was such a great investment, obviously there's some people who probably wouldn't have been excited about the company because of that. But I'm not looking to invest in 10 more French women because I've been successful with that investment. This is just clearly not, the right way to do it. But in terms of personality, I'm looking for outliers. So I think patterns is a weird thing because even taking aside what the founder looks like, which you really should not be judging them on, there are first-time founders that we might back, there are experienced founders we might back, and we can do well with both. There could be Bay Area founders and founders that are far from Silicon Valley. There could be a solo founder, a founding team that's 3 co-founders. There could be a very technical founder, and obviously I was a technical founder, and I like technical founders, but sometimes they're non-technical founders who have more of a business background and do really well. So the idea that I'm looking for the same thing, I'm really looking for outliers. And we might invest in 2 startups for completely different reasons. They both have to be exceptional and impress us. But in one case, we might really be excited by some nerdy technologists that we think are going to need help in mentorship on the business side, but we're still excited. In the other case, it might be some experienced business people who have deep domain experience in an area. And the reason why we got excited to make that investment could be very, very different. So I think pattern recognition is such a weird term for a business where it's all about outliers.
Right. It's very well put. I know a lot of people would agree with you. Let me ask you another question, switching a little bit. As you look for outliers, are there key signals that do you have a checklist of things you're like always looking for?
I don't know if I would call it a checklist, but there's certainly things that I have noticed matter and that we care about. So engagement and initiative, is definitely something that I've noticed, not just for founders, but even for people I've hired to work for me. So, I like people who are very proactive. I like people who do their homework. I like people who take the initiative. I like people, who send follow-up, thank you emails, and just people who are really engaged.
Yeah.
And, I think that those subtle things are often a hint of just how they do business.
Mm-hmm.
So that, that's something I've noticed. I think also the commitment level, if somebody still hasn't quit their job and they're sort of, not even sure, or if they have 5 different ideas and they haven't, they want to start a startup and they've got 5 different ideas and there's not one they've actually picked, or if they're thinking too small. I mean, there's a lot of things that are really, I think, relevant in investing very, very early in the seed or pre-seed stage. I mean, we definitely wouldn't invest in a founder we loved who was working on a product or market we hated, but obviously so much of it is judging the founding team and their ambition level, their energy, their commitment, all of those things.
Yeah. Diving into maybe an anecdote, is there an example of a couple of companies or just one company that maybe checked all or most of your boxes you're really excited about, went south, which happens all the time, but usually there's a lesson learned or 2 or 3. Anything you can share around that?
Do you mean a company that went south after I invested, or a company?
Yeah. Like you were like, you've met a company, checked all the boxes, initiative, et cetera. You're like, this is going to be great. And then things don't work out, which again happens all the time. But was there maybe a lesson learned?
Not really. I mean, the truth is startups fail, businesses fail. It's very hard. And the earlier you're investing, the more likely that is. So when you're investing, if you're investing in a portfolio of angel or seed stage investments, you're expecting a lot of them to fail. And if you try to avoid that, if your goal is to reduce the mortality, I actually don't think you're going to build a successful portfolio, because you're really, that's generally not the way it works. And the returns usually come from a few outliers. So trying to sort of avoid that is probably a mistake. Looking back, before I started 8-Bit Capital, I'd done around 50 plus angel investments. And of course, there were several that failed. One of the things I noticed was that the ones where I had sort of just tagged along with some other friends who were investing, rather than had my own conviction based on just something that I alone got excited about, those were more likely to fail. But they still failed for different reasons. Of course, usually the issue is either a founder conflict or product or failure to get product market fit.
Yep. I think people underappreciate how much founder conflict actually torpedoes startups. Let's talk a little bit about some advice you would give your former self, when you were just getting started. For a lot of the folks that are on the Zoom right now, they're early in their angel investing career. What are a few things you'd have told yourself then, especially as it relates to key signals?
For angel investing? I would say a few things. Focus on areas where you have some expertise. I think that it can be fun to invest in random things. As an angel investor, you're not obligated to do that. I mean, when you're managing other people's money, you have to be pretty serious about it. As an angel investor, you can throw some money into things that just seem fun and interesting if you want to. It's your money. But in general, I think you're better off focusing on areas where you have some domain expertise, and not just sort of being all over the place. I think it's good if you're really planning to do angel investing, to plan to do at least a minimum number of companies, because the risks are high. Most companies fail, and you want to have some minimum amount of diversification. So I wouldn't suggest somebody do 5 angel investments. If you're going to do it at all, you probably want to have at least 20 at a minimum. So you might want to start with smaller checks into a larger number of companies. Those would be some of the basics.
Yeah.
And you really have to be prepared to lose the money, of course.
Yep. That's a disclaimer we have, I think, on every slide. It's definitely, it's part of the game is that huge risk. Question for you. Let's say you've got you're further along in your career. You kind of know how to look for outliers. You know what signals you're going to look for. You get a lot of deal flow, right? Because you become more active. How do you filter that deal flow, especially again applying these signals?
Yeah, that's a big challenge. And I think the more successful you are as an angel investor or even a full-time investor, you're just going to get more and more and more deal flow, and sorting through it all actually can be challenging. In our case, most of it is just not worth pursuing. I mean, one of the silly things is every day I get a whole bunch of emails and a whole bunch of LinkedIn messages. And LinkedIn is really not the right way to reach out to an investor, but I get messages about investments that are way outside of anything I would invest in. Cannabis, cryptocurrency, robotics, biotech. I mean, just thing after thing after thing that is obviously completely zero fit for me as somebody who invests in software only. And it's so easy to do your homework because you can look at my personal website, you could look at AngelList, Crunchbase, LinkedIn. I mean, so many places to see my the companies that I've worked at, and the companies I founded, and the companies I've invested in, and so that's kind of strange. Then within the companies that are relevant, we do have a thesis now at Apex Capital. We focus on software that connects people. So a lot of things are just not a fit for us, most of it is just not actually terribly interesting, but it's still a difficult thing to sort through it all because you just never know. And sometimes there could be a pitch that just seems not very good, but actually, it ends up being an incredibly successful company. And sometimes you see a really, really slick pitch, but it's, not the right team or a bad company. So I think it's difficult. I mean, I think that's when you're going to focus on, your experience and hopefully, some knowledge you have of the people or the industry and, some sort of, focus or filter or thesis to help you wade through all that deal flow.
Totally. Another question for you. What tools, specifically software, books, have you used as you figure out what signals you want to start paying attention to or filtering, et cetera?
Yeah, I mean, we don't really do a lot of that sort of data-based, investing where we're looking at all, signals and rankings and things. Generally, I prefer to be investing before there is a lot of that kind of stuff. There are some investors who are mining all these different sort of data signals and to try to find things. It's not really what we do. Now, we obviously use the usual things like Crunchbase and LinkedIn and CRM. Well, some of those things, were less obvious when I started doing angel investing. And, when I started my career as an entrepreneur and raised money from investors, there was no LinkedIn, no Crunchbase, no Y Combinator, no AngelList, and you still obviously did it. Entrepreneurs still found investors and still raised money without those tools. So, I mean, I think it's not so much as the tools as how you use them and the time you put into it.
Yeah.
Like I said, there's people on LinkedIn every day sending me things that are completely not a fit for me.
Yeah.
So I think it's simply a matter of how much you're putting in the initiative to use any of these tools properly and just put in the time and do your homework.
Totally agree. Another question. So as you began your journey, continued your journey as an angel investor, were there other angels that you learned from, and what did you learn? Maybe one or two lessons.
Oh yeah, of course. I'd say back in the sort of the earlier days, Paul Graham and Naval Ravikant and Mark Andreessen, all those folks started writing and blogging stuff, and a lot of it was extremely interesting stuff. I mean, a lot of it was stuff that would have probably benefited me in the early part of my career before that kind of knowledge was around. And they, Elad Gil as well. A lot of those folks have written a lot of interesting stuff about not only entrepreneurships and running startups, but about angel investing. And right now, it's probably the opposite problem. There's so much content; it's hard to know what to focus on. My partner Kent Lindstrom has a podcast called Something Ventured, and he's had a lot of great investors and entrepreneurs on his podcast. And there's so many other great podcasts. Podcasts, I think, are actually a really good way to learn because almost any investor, if you Google, has probably been on several of these podcasts. So if you think, oh, that entrepreneur or CEO or famous person or investor, somebody I want to learn from, you can probably just Google it and find 5 podcasts they've been on and just sit there and listen to them for free in your house without having to pay to go to a fancy business school. So there's a lot of interesting content out there. There's, I would say the podcasts are actually pretty good because you're hearing from the person directly versus it being, reinterpreted by, a news article.
Got it. We're almost out of time here. Is there anything else as it relates to key signals or angel investing in general? A lot of the folks that are tuned in and will be tuning in are very early in their career. They're actually, many of them are unaccredited, so they're investing as little as $100 sort of as they get started. But they're all, well, I shouldn't say they're all, but many of them are sort of inspired to sort of continue their career and invest more and more over time. Any thoughts you'd share about your own journey or just things you learned or just general advice?
Sure. So when I was angel investing before starting 8-Bit Capital, as I said, I did over 50 investments. And in addition to making money and helping people, my third goal was to learn. So that's why I want to do a lot of investments, because I don't think you can learn enough about, 3 or 4, it's not enough. In addition to diversification, you're just not going to learn enough until you've done, larger number. So I was also busy running companies, so I didn't have a lot of time to do it back then. And so I would have to be opportunistic. And sometimes it was serendipitous encounters. But I also invested in Y Combinator companies at Founders Den, which is a community that I co-founded in San Francisco, as well as on AngelList. And I should disclose that I was one of the early investors in the company that became AngelList. And obviously, AngelList and Republic are really cool because somebody can go on those platforms and sort of piggyback off of somebody else's who's a little bit more knowledgeable, their due diligence and their deal flow. So I think that can be a good way to start. Is finding deals that are sort of pre-vetted on a platform like AngelList or Republic, and then doing a bunch, small checks, and doing a bunch, and following somebody like yourself who's found something and then sharing it on one of these platforms. I think that's a good way to start because you're gonna learn, you're gonna probably write smaller checks, so it's not as risky, and you can be sort of piggybacking off of the things that maybe people who are more further along in their angel investing, career are going to be finding.
Yep. Awesome. I really appreciate that. Cheryl, I think we're up on time here.
Yes, we are actually, but thank you so much, Jonathan, for your time, your expertise, for that special plug on Republic. We didn't pay him, everyone, so. But Jonathan, if you want to put any way that you want folks to contact you, please do so in the chat now. I think we've all appreciated all your insights.
Really appreciate being here, Jonathan.